Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 189 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Today we are going to be talking about single stocks, as we've been talking about throughout the course of this week, individual stocks, but what I specifically want to focus on is the risk inherent to individual stocks, and if individual stocks are actually more risky when it comes to investing in them than it would be to invest in an index fund or a mutual fund or bonds or some other type of investment, because these individual stocks, they get this mantra of being very, very risky, and I want to set the record straight as to how I see individual stocks as far as a risk profile point of view may go. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, and be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan that's specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.MNOwithDylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So Warren Buffett has this saying, this famous quote that says, "Risk comes from not knowing what you're doing." And I believe in this. In many cases, I believe that a lot of risk that people end up taking on comes from the fact that they don't know what's going on in their life, in their financial life, in the situation that they're in. A lot of risk comes from not knowing what's going on. And I think that is a big problem, especially in investing. And when we're talking about how risky a specific type of investment is, a certain type of investment can seem a lot more risky simply because that type of investment has some volatility associated to it, but that does not necessarily mean that particular investment is risking loss as much as another may be. I'll give you a perfect example. Amazon, for many, many years, was a growth stock. It was from the tech bubble. It made it to the other side of the tech bubble because it was a legitimate business and not just one of those .com names, right? It made it to the other side of the tech bubble, and they continued to grow, and they were growing at an extremely fast rate. And anytime you're growing as fast as Amazon was, there's going to be volatility in your stock price. There's going to be ups and downs that are very, very extreme. And people saw Amazon as a very risky bet, right? But at the same time that Amazon was going through this, right, there have also been companies of adequate size that were some of the larger constituents of the S&P 500, of the Dow Jones Industrial, such as the Enrons of the world, right? And then Enron comes out with this huge scandal, and Enron basically goes under, files for bankruptcy, and becomes worthless eventually. Now, just because Enron was larger and better known and seemed to have things more together did not mean that Enron was less risky than Amazon was. Quite clearly, investing money in Amazon, if you had all available information, would be less risky than investing that money in an Enron. Right? But people saw the wild swings in the market. They saw the wild swings in the stock price of Amazon, and they really didn't want much to do with it because it was unproven and really wasn't profitable until the recent past. Okay? But does this tell us that individual stocks are just far more risky than anything else that we could do investing wise? Well, the answer in short is no. Okay? But in a longer version of this answer, which I'm going to give you throughout the course of today's episode, is that yes, individual stocks by themselves bring a little more risk than there is associated with large groups of companies or fund investing, ETFs, mutual funds, and things of the like. And I'm going to break down exactly what that looks like. And I think it's important for us to start in a place where we understand what the different types of risk are. Right? There is systematic risk and there's unsystematic risk. And some people call these non-diversifiable risk and diversifiable risk, right? And what does this mean? there's risk to any investment that you take on, obviously, right? There's some risk of loss, okay? But the risk is either associated with the market as a whole, and specifically we're talking about the stock market here, but the risk is either associated with the market as a whole, or that risk is associated with the individual company or the individual investment, something that is specific to that investment. And simply due to the fact that one individual company or one individual type of investment is going to have some individual characteristics that are different than the market as a whole, and that are far more fragile to things going on in the economy, they will take on more risk, right? An individual company is going to be more risky than all the companies in the universe, right? If you took all the companies in the universe and you put them all together in some equally weighted fund, which is done many, many times over. When you talk about total stock market indexes, this is done. And the idea of those indexes is just this massive diversification. And what they are trying to diversify away, whenever you're trying to diversify, you are diversifying away the diversifiable risk, or what we call the unsystematic risk. Okay. And this is risk that is not specific to the market, but specific to the individual companies. And the whole idea is that if you have 1,000 companies, right, if 30 of those 1,000 companies go bankrupt and cease to exist over the next 10 years, 15 years, right, that does not mean that the value of those 1,000 companies as a whole wouldn't have gone up, or gone up substantially even. Okay. But if you just own one company and that one company goes bankrupt and you held its shares, well, the value of what you held literally went to zero. Okay. So instead of making a bet on one thing, on one company, on one set of results, you are making a bet on many. Okay. And so this really brings us to talk about individual stocks versus fund investing. Now, full disclosure, I do both. Okay. I invest in both individual stocks, and I invest in index funds, mutual funds, things of like ETFs that track the broader market. I invest in those different types of things. I specifically use a lot of Vanguard ETFs and mutual funds because those are some that have been around the longest and have some of the best track records and have very, very low costs associated with them. So if you are going to invest in different funds, then that may be a good option for you. But there are several companies that do it very, very well, and we'll talk about that a bit more in tomorrow's episode. But something that I want us to understand is that your risk profile is going to tell me a lot about what you should be doing when it comes to your investing. Okay, if you aren't willing to put in the time and to do the homework and to do the analysis on individual stocks, I've told you many, many times before, you should not invest in individual stocks, because investing in individual stocks without understanding what those particular companies do is just going to create more risk in your life. Why? If we go back to the Buffett quote, risk comes from not knowing what you're doing. And you literally do not know what you are doing if you are investing in a company that you have not done the homework on. Okay, and so you create outsized risk for yourself by investing in things that you don't understand and that you don't know what to do with. Okay, but this really takes us back to the investment philosophy of Peter Lynch that we talked about earlier this week. And the first thing that he says that he does when he is trying to pick an individual stock is he says, do I understand the business? Right? Own what you know. Invest in things that you actually understand. And in understanding them, that decreases your risk profile. And so when you want to invest in individual stocks, if you are able to do your homework, understand the company, understand what the company does, be diligent about understanding their numbers and their future prospects, right? You can take away a lot of the risk that is inherent to investing in individual stocks. The problem is that most people don't want to do this, okay? And those people really fall into three different camps. There are people who don't want to do this, but they invest in the companies anyway, and therefore take on the outsized risk. Okay. There's the second group of people, which I think is the correct group of these three. These are people who don't want to do the homework. Therefore, they invest in index funds and mutual funds and more fund-based investments, right? They invest in those types of things and allow their money to grow there and don't get involved in the individual stock game. And I think that is definitely the way that you should go. If you're not going to get involved with individual stocks, then you should make sure that you are still investing elsewhere and invest in places where money has been shown to grow over the long term. And then there's the third group. And the third group are individuals who don't want to do the homework. And then they look and go, oh, well, if I have to do all that to even invest anything, which is not true, right? But if they think that's what you have to do to invest in the first place, then I'm just not going to invest anything, right? They can be forced into not doing anything by the fact that they would have to do some work to invest in individual stocks, okay? Individual stocks are very, very attractive. And the past year has really proven a lot of individual stocks to be very, very attractive. I mean, if you were invested in Tesla's stock a year ago today, your returns would be outrageous. In just 1 year's time, you would have made over 400% on your investment in Tesla, which is outrageous. And that is one individual stock. And especially that type of return is outrageous when you think about the types of returns that you expect from the stock market year over year. The types of returns that most investors look for are like 10% per year returns. And so Tesla made a bunch of people rich. Okay, Tesla has made a bunch of people rich as its stock has continued to climb and climb. But that does not mean that only investing in one individual company is the way to go. And the reason that that is the case is because why were Tesla's returns so high? Well, Tesla's returns were so high because Tesla has a certain amount of risk inherent to them. And we talk about risk to what? Well, risk to the fact that they are an auto manufacturer that is doing something new and different and breaking new ground all the time. And they're constantly trying to do new research and development, which can be good things, but it can also lead to some losses for the company if done incorrectly. Okay, they are getting more competition in the electric vehicle space, which can be, detrimental to their value. But if they continue to be the top dog, then there's absolutely nothing wrong with investing in a company like that. They have a CEO who is broadly seen as a genius, and I really agree with that sentiment. But he is very volatile in his statements. He says a lot of things very rashly and doesn't really care too much about what the media thinks or what the investing community thinks in a lot of cases. Okay, so there are individual risks to Tesla that are specific to them. This is that diversifiable risk, right? You can diversify away the risk that Tesla holds by itself. Now, how can you do this? How can you diversify away that risk? Well, Tesla is a company that is held in the S&P 500. Right, the S&P 500, for those of you who don't know or haven't watched this channel too much or haven't listened to my other episodes, the S&P 500 is a group of the 500 approximately, right? It can really vary between 490 and 510, somewhere around there. But it's, in general, the 500 largest companies in the United States. And they are the biggest and the brightest, and they are, headed by the Apples of the world, the Amazons, the Exxon Mobils, all these companies that are really popular American companies can typically be found in the S&P 500. Well, Tesla is in the S&P 500. Now, they are not a huge portion of the S&P 500 like Apple is. Apple is somewhere like 5-6% of the entire index, even though they're only one of the 500 companies. But Tesla's not a huge percentage like Apple is, but they are a part of that index. So you could hypothetically get exposure to Tesla stock without investing in Tesla directly. And the way that you could do that is by buying an S&P 500 index fund. And so what you do when you buy that S&P 500 index fund, not only do you invest in Tesla, but you invest in all other 499 companies within the S&P 500, and obviously in small amounts because the money gets spread, right? And you get small exposure to every single one of those companies. Okay, now what does this do? This diversifies away some of the risk. This diversifies away the risk inherent to investing in a company like Tesla alone. But it allows you to take on the returns of all these other companies, many of which have returns that are not positively correlated with that of Tesla. And I can give you another example there. Over the past year, something that has really been in the news and has really been a big deal are the stay-at-home stocks versus the reopening play, right? Because COVID-19 put us in a position where a lot of people were staying at home. The world is changing. It's still changing, and we still have some big residual effects from the fact that COVID-19 has made an impact on our economy. But there have been a lot of companies that have had outsized gains in the past year because those companies are really good stay-at-home stocks. Well, as the economy reopens, a lot of the companies that thrive when people can go out and do things and really get out of the house, those things are going to thrive, and the stay-at-home stocks aren't going to do as well. And that's kind of what's occurring right now in the broader market, right? So you can think of companies that are really big stay-at-home stocks like Peloton, right? Peloton that makes the bikes that people are exercising at home. They're trying to stay in shape without having to leave the house. Then Peloton is a very good performer as a stay-at-home stock. But when it comes to the reopening trade, you may see companies like United Airlines or American Airlines, some of the airline stocks where people are going to be able to travel again, and that is going to positively impact their stock returns and their bottom line. And so the entire point is that those companies, at least over the past year, they have returns that are not positively correlated with one another. If anything, their returns are probably negatively correlated. And when you buy a fund, an index fund or a mutual fund that has a bunch of different companies that are held within it, you will have a lot of companies whose stocks move in the same direction. You will have some companies whose stocks are negatively correlated with each other in a strong way, maybe negatively correlated in a weak way, or just positively correlated in a very, very weak way. Okay, so it all comes down to, when you are diversifying away risk, it comes down to the correlation of returns between one company's stock and another. And so this shows us that yes, we can get rid of some of the risk, and specifically risk that is associated with volatility, that is associated with the just wide swings in a stock's price. I'll go back to talking about Amazon. Amazon, over the years, as it has grown, it has had many years where it's had 20 to 30% drops in the stock price. Wouldn't you have loved to buy those dips, right? But it's had 20 to 30% drops in the stock price many, many times. But this does not mean that its growth trajectory was changing. It does not mean that the company was not going to get larger and bigger and better over time. Obviously they were, and obviously they have, because now who brings you packages to your door? Amazon, right? And who sells you everything that you could expect to be sold to you at any store that you may ever go? It's Amazon, right? Amazon can get you just about anything that you need. And believing in that has made a lot of people very, very wealthy by owning that stock over the long term. But what risk did they take on? They took on the risk that Amazon would still exist. They took on the risk that if they put all of their money into Amazon, that the value of that Amazon stock could go to zero, right? And it just took one company to go to zero to lose all your money. Whereas if you are investing in a particular fund, right, in order for your money to go to zero, that means every single company within that fund must go to zero. And the likelihood of every single company going to zero is just about zero. And the reason that is because if every company that we know and love has, or maybe you don't love them too much, right? But every company that we know of, if it were to go to zero, then our world would cease to exist in the way that it does today. Our economy would cease to exist in the way that it does today. Our country would cease to exist in the way that it does today. Okay, and so this is just not very likely. And you look at the long history of the S&P 500, the Dow Jones, the NASDAQ, this is just not really in the cards unless something catastrophic is to occur. Okay, so what we have to understand is that yes, there is a risk to losing money in an individual stock in the short term, right? You can make outsized returns in the long term, okay? But if an individual stock goes to zero, you lost everything. But a fund is not going to go to zero. A fund can still provide you good returns, but funds are unlikely to provide you some of the outsized returns of stocks like Tesla and Apple and Amazon and Netflix, how they've done over the past 10 to 15 years or so. You're not likely to find those types of returns in a fund that you're invested in, but they can provide you the returns of the broader market that will allow you to grow over time and take away some of that volatility that you may find in individual stocks. So the question really comes, should you invest in individual stocks at all? Well, I've told you many, many times, I think that if you can do the homework, right? If you have a level head, if you're patient, if you can actually invest for the long term and not just short-term trade, then putting some of your money in individual stocks is a perfectly fine thing to do. I think you can put money in individual stocks and make abnormal returns and make returns that are better than those of the market. I've done so myself, so I believe that you can do so as well. The problem is that people think that they should just put all their money into individual stocks, and I don't think that that's the case. I think the vast majority of what you have still should go into index funds like the S&P 500 index fund. I still think that it should go into mutual funds or ETFs or things of the like that are more broadly diversified, that take away some of that diversifiable risk, okay, and really leave you with that risk that is not diversifiable, the risk that is systematic, and risk that you're going to have to deal with anyway. And it can allow you to have more stable returns over the long term, and that can be very, very beneficial to you and your portfolio. Look, I am not somebody who's going to sit here and say that I think everybody should invest in individual stocks. No. I understand that most people don't make money in individual stocks. Most people do lose money by investing in individual stocks. And far more people lose money by day trading. They lose money by trying to trade individual stocks over the short term, which I definitely think is a horrendous idea. I don't think that's something that anybody should be doing. But I do think if you can find companies that you believe are going to grow over the long term, that you've done the homework on, that you understand their company, that you can make long-term educated bets on these companies, that you could make really, really good returns. Because there are companies that you can just look at today and go, there's no way that company goes away in 10, 15, 20 years, 30, 40 years, right? There's no way that we no longer have this particular company in our lives. I mean, we talked about Amazon a few times throughout the course of this episode. Amazon is a company that is very ingrained in the life of most Americans now, so it would be very hard to see the world without an Amazon. But that said, we have to understand that when the story changes, we can change our investment thesis, because there have been many, many companies over the long term that have had really good stories, that have had a lot of success, and then the world changes, the economy changes, and individuals have to shift to different products, different services, and different companies end up taking over. That's not saying I believe that happens with an Amazon or any company like that, but I'm just saying that there's a possibility, and that has a lot to do with that individual stock risk, right? So I do think that individual stocks carry more risk. It's proven. They do carry more risk. They do carry more volatility, right? They do carry a lot of things that a lot of investors don't want to have to deal with. They carry some stress, especially if you don't know what you're invested in. They carry some stress for a lot of investors, or even investors who do know what they're invested in, but they worry far too much about the performance of their one individual company that they own. I think that you can easily get yourself out of that, at least in large part, by investing in index funds and ETFs and things of the like. But all this said, that doesn't mean that you have to be just an index fund investor or just a fund investor in general. You can put some of your money into individual stocks, but have a percentage of your money in individual stocks that you feel comfortable with. Not money that you're willing to lose, because we're not gambling, we're not making bets. We are investing for the long term, and we are still investing in more than one individual stock. Look, my individual stock portfolio is not a group of one or two stocks. No, it's not one or two stocks sitting within that portfolio, but it's also not 100, right? Because if I want to own 100 stocks, then I can go out and buy the S&P 500, or I can go out and buy the QQQ NASDAQ index, right? I can go buy those types of things if I want that much broad diversification. But my single stock portfolio is typically anywhere between, sometimes 7 to 15 companies. I think right now it's right around 9 or 10 individual stocks, right? And that doesn't change a whole lot over time. And those individual stocks were specifically chosen by me, and I did the homework and I understand the companies, because the more companies that you put in your individual stock portfolio, the more companies you're going to have to do the homework on. And who has the time to do the homework on 100 companies? Who has the time to understand 100 companies? I know I don't. Okay. And so if you don't have time to invest into those companies, right? You don't have time to invest into reading their financial statements and doing the homework, understanding their numbers, understanding what they do, all these different types of things, then you are going to end up in that place where you take on risk in the way that Warren Buffett said. You are taking on risk because you do not understand what you're invested in, right? You are taking on risk because you don't know what you're doing. And that can be extremely problematic. And I don't want that for any of you. I want you to take on educated risk, because we do have to take on risk if we want to make any type of return. That's one of the basic rules of finance, right? More risk, more return in general, okay? And so we are going to have to take on risks if we do want to make very good returns over the long term. But we need our risks to be calculated, and we need our risks to be to where we know that we are still going to make money over the long term. We know that we are still going to have positive returns over the next 10, 15, 20 years, whatever it may be. And just based on history, we can know that this is the case. And based on understanding what companies do and how companies work and how companies' revenues are going to grow over time and their earnings are going to grow over time, you can do the same thing with individual stocks. So I implore you, right, if you want to invest in individual stocks, do your homework. Okay, understand what the companies are and what the companies are doing, and you will be able to take some of the risk that is inherent to investing in individual stocks and shift that risk away. Okay, a lot of the risk goes away if you just understand what you are doing. Now, you have to have a gut. Okay, you have to have a tough gut, because you're going to get punched many times with individual stocks. Okay, there's a lot of stuff going on right now where individuals are getting punched. I talked about Peloton a little bit earlier, and Peloton is going through a lot of issues with their treadmill right now, and a child being injured and then eventually passing away from an injury from their treadmills. And that is something that can happen, that can change the value of the stock very, very quickly and very, very swiftly. Okay, and then you have to check your gut. You have to see if you still believe in a company, if you still believe that a company can do what you thought they were doing in the first place. And remember, don't be afraid to change your holdings if the story changes. But just because something happens in the short term does not mean that the story has changed, does not mean that the company has changed, and does not mean that you can't make outsized returns over the long term. So you have to have a tough gut. You have to be able to take some volatility and take some firm-specific news. But if you can hold on through that, and you can understand what your company does and stick with them over the long term, then you can make some very, very good returns. And I look forward to seeing what types of things you guys can do with this information that I've given you. And hopefully this helps you to understand a bit more that, yes, there's risk inherent to individual stocks, but there's risk inherent to all of your investments. And the more you know, the less risk there will be. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, then be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan that is specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.MNOwithDylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. Tune in tomorrow as I talk about where you can purchase your individual stocks. And when I say where, I mean the companies that you can use, the apps you can or should use, and the types of accounts in which you can purchase individual stocks and where I purchase my individual stocks. So stay tuned for that in tomorrow's episode. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.